If you hide a $100 bill under your mattress, you aren't keeping it safe. This timeline shows how a 3 to 6% annual inflation rate erodes your money's value. Holding cash mathematically guarantees a loss of wealth over time. Beyond inflation, predictable life emergencies like a sudden job loss or medical crisis strike eventually. Without financial preparation, these moments become catastrophic. Lacking cash for an emergency forces a reliance on credit cards. This Schumer's box, the standardized disclosure required by law, shows how penalty annual percentage rates soar to nearly 30%. You end up borrowing money you don't have at a premium you can't afford. The 50-30-20 rule provides the framework needed to stop this bleed. It allocates 50% of after-tax income to needs, 30% to wants, and 20% to savings. This 20% represents the mandatory capital required to participate in long-term wealth generation. Budgeting is a structural mechanism for building a defensive wall against economic drains. It protects your future autonomy by ensuring your money works for your goals, rather than disappearing into interest fees. Establishing the first pillar involves a specific definition of saving. Saving is the process of storing money in a low-risk, highly liquid environment for immediate deployment, which is a distinct function from investing. A fully realized savings system requires a decaded fund hovering exactly 3 to 6 months of baseline survival expenses. This capital remains untouched unless a genuine crisis occurs. Insurance serves as the logical partner to those savings. It allows for the mechanical transfer of catastrophic financial risk to a third-party entity. Capital management also requires distinguishing between types of debt. Bad debt consumes capital for depreciating assets, while good debt leverages borrowed money to acquire future value, like education or property. Your credit score measures reliability for good debt. This gauge isolates the biggest variables: payment history at 35% and utilization rate at 30%. Lenders reward a high limit paired with a tiny usage sliver. Low utilization proves discipline, earning lower interest rates. Mastering these tools, liquid savings, risk transfer, and credit reliability, creates an impenetrable safety net. It prevents temporary emergencies from becoming permanent debt spirals. Once the safety net is securely locked, the surplus from the 20% budget immediately fuels the growth engine. This is where capital is deployed to generate passive wealth through compound interest. Miguel and Jasmine illustrate time's leverage. Miguel invests $25 monthly. Starting early allows 4 decades of compound interest to multiply his capital exponentially. Jasmine waits a decade, contributing double at $50. Despite higher contributions, she mathematically fails to overcome his head start. Apply this same objective math to the debate between renting and buying a home. This balance sheet for a $400,000 home breaks down hidden variables. Beyond the mortgage, property taxes, interest, and maintenance drain capital annually. Consider opportunity cost. Investing the unspent down payment in the S&P 500 for a 7% yield makes renting mathematically superior. Wealth generation requires looking past emotional assumptions and prioritizing objective, time-leveraged mathematics. Financial literacy is the ability to correctly categorize capital into protective systems and growth engines. Without these systems, wealth is quietly siphoned away by the economy. You remain a passive participant in your own financial life. Chronological time is the most critical variable in both risk mitigation and wealth generation. It dictates whether your math works for you or against you. Audit your budget today to locate your 20% surplus. Automate your systems immediately to ensure the mechanics of finance serve your future autonomy.